Welcome back to Silver and Metal IQ. I'm Peter, and today we're diving into a story that should make every gold and silver investor stop and pay close attention. If you squeeze something hard enough, long enough, it doesn't stabilize. It collapses. And that is exactly what appears to be happening right now in South Korea's gold and silver market. This isn't a rumor. This isn't social media hype. This is confirmed activity coming directly out of Korea's banking and minting system, and it may be one of the clearest real-world examples we've seen of what happens when physical demand overwhelms supply. Over the past several days, multiple independent sources out of Korea have reported something extraordinary. Major banks have halted the sale of gold and silver bars, not because prices are volatile, not because demand cooled, but because there simply isn't enough metal to meet demand. The system hit its limit. The first alarm came from reports involving KOMSCO, the Korea Minting and Security Printing Corporation, one of the most respected mints in the world. Initially, it was reported that silver supply was tightening, then gold bar sales were paused, and now, according to multiple Korean financial outlets, both gold and silver bar sales have effectively been frozen across major commercial banks. Let that sink in for a moment. In a modern, developed economy with sophisticated financial infrastructure, investors can no longer buy standard gold and silver bars through the banking system. That's not a pricing issue. That's a physical availability issue. According to the Korea Times, banks halted silver bar sales amid surging demand driven by global uncertainty, particularly surrounding geopolitical risk, trade tensions, and economic instability. Gold bars had already become the go-to safe haven asset, and as gold prices surged to record highs, investors turned aggressively towards silver as an alternative. The result? Runaway demand and depleted inventories. Major banks affected include KB Kookmin Bank, Shinhan Bank, Woori Bank, NH Nonghyup Bank, and others. Some institutions attempted to continue sales by draining remaining inventory or sourcing alternative suppliers, but those options are rapidly disappearing. Once the remaining stock is gone, that's it. What makes this even more significant is that this isn't just a temporary pause on small bars. Reports confirm that even 1 kilogram gold bars, worth over 160 million won, are no longer reliably available. When even large, high-value bars vanish, that tells you demand is not coming from casual buyers. This is serious capital moving into physical metal, and this isn't isolated to one headline or one source. Korea's top financial publication, Mail Business Newspaper, confirmed that both the Korean Gold Exchange and the Korean Mint formally notified banks that silver bar supplies would also be suspended. Another outlet, Business Korea, confirmed that the ripple effect has essentially paralyzed the retail precious metals bar market. This is what a real squeeze looks like. Not on a chart, not on paper, but in physical reality. Now, it's important to be clear. This does not mean the same thing is happening today in Western markets like the United States. Physical gold and silver are still available here. But what Korea is showing us is something critical: how quickly availability can vanish when confidence shifts and demand accelerates. And that raises an important question we'll explore next. If this can happen in Korea, how immune is any market when physical demand overwhelms supply? First, let's talk demand dynamics. Since Donald Trump's election and subsequent policy announcements, including tariffs and global trade moves, Korean investors have rushed towards safe haven assets. Gold prices have repeatedly hit record highs, and silver, still relatively undervalued compared to gold, has become the alternative of choice. This surge in demand has outstripped supply at multiple levels. The Korean Minting and Security Printing Corporation, KOMSCO, responsible for producing gold and silver bars, halted supplying bars to banks. Meanwhile, the Korean Gold Exchange, which had already suspended smaller bar sales in 2024, is now forced to restrict 1 kilogram bars as well. Essentially, the entire commercial bar market is constrained. Banks such as KB Kookmin, Shinhan, Woori, and NH Nonghyup are scrambling to meet orders. Some are depleting existing stock or sourcing from overseas suppliers. But the reality is that once the remaining inventory is gone, sales stop entirely. This is not speculation. Reports confirm official communications from the Mint and the Gold Exchange were sent to all major banks, instructing them to halt bar sales. Now, why silver specifically? With gold at record highs, investors naturally pivot to silver as a lower-cost hedge. Silver's dual role as both an industrial metal and a store of value makes it particularly vulnerable to supply strain. Even small surges in physical demand can create cascading shortages. And Korea is experiencing that exact phenomenon. It's also important to understand market scale. Korea's domestic bullion market is smaller than the US or Europe. That means even moderate demand spikes can overwhelm supply, whereas in larger markets, inventory buffers exist. What we're witnessing is the physics of supply and demand in action. The more you squeeze, the harder it collapses. Historically, these supply squeezes appear during periods of extreme uncertainty. Economic crises, currency volatility, geopolitical tension all drive investors to safe haven assets. Korea's current situation is a textbook case. Global uncertainty triggers panic buying, which in turn creates supply constraints. For investors watching from abroad, the takeaway isn't that the US market will collapse tomorrow. Rather, it's a warning signal. When safe haven demand spikes suddenly, even the most developed markets can see rapid premiums, tight availability, and temporary supply halts. Korea is a live experiment in what happens when physical metal is hoarded faster than it can be produced or distributed. First, consider the ripple effect of constrained supply. Korea may seem like a small market compared to the US, China, or Europe, but when banks halt sales and mint supply stops, it creates a localized vacuum. Traders and investors outside Korea are now eyeing alternative sources, driving cross-border demand, which can put upward pressure on international silver and gold prices. Secondly, the psychology of scarcity plays a big role. When buyers see shortages in one part of the world, even if their local markets are stable, they tend to accelerate purchases, fearing they might miss out. This effect has been seen in previous silver surges, including the 2020 silver squeeze, and it reinforces volatility and price spikes in the market. Another critical factor is industrial demand for silver. Beyond investment, silver is heavily used in electronics, solar panels, and medical applications. As demand from investors increases, available physical silver for industry shrinks, potentially creating a supply bottleneck that affects production globally. This is one reason why monitoring physical availability is as important as tracking futures prices. Let's also touch on gold's role. With gold at record highs, investors often pivot to silver as a lower-cost alternative. In Korea, this pivot has been magnified because smaller investors cannot access gold bars, pushing them into silver. Globally, this creates a secondary demand surge, which can influence premiums in nearby markets, including Europe and the US. Finally, geopolitical and economic uncertainty is a fuel for this fire. Trade tensions, tariffs, and global market instability encourage investors to hold physical assets rather than cash or bonds. Korea's market squeeze is a microcosm of what can happen worldwide if global uncertainties persist and safe haven demand outpaces production. In short, Korea's silver and gold market isn't just a local story, it's a warning and an opportunity for investors globally. Those paying attention now could capitalize on pricing anomalies, secure physical metal, and prepare for potential volatility in both silver and gold markets. While silver is currently under tremendous demand in Korea, gold remains a key safe haven asset globally. Investors should consider allocating between both metals, depending on their investment goals, storage capacity, and risk tolerance. Silver offers high leverage potential, while gold provides relative stability during extreme market events. Next, pay attention to physical availability and premium pricing. When markets experience shortages like Korea, premiums on bars and coins can spike well above spot prices. This is particularly true for smaller denomination bars, which tend to sell out faster. Investors should consider dollar cost averaging, purchasing smaller amounts over time, rather than trying to time the market perfectly, which is nearly impossible in volatile conditions. Another critical strategy is understanding trusted suppliers. Summit Metals, for example, offers competitive pricing, fast shipping, and a reliable supply chain. During times of global scarcity, sourcing metals from reputable dealers ensures that your purchases are genuine and delivered on time. Avoid unverified sellers or speculative offers, which can increase your risk. For those holding existing inventory, now is a great time to reassess your stack. Evaluate which metals or denominations are most in demand and which might have lower premiums. Selling some pieces strategically to reinvest in higher demand metals can optimize your portfolio. This is particularly useful if your goal is liquidity in a market where bar supplies are limited. We also need to consider international market dynamics. While Korea is experiencing a freeze in retail and bank sales, other countries may have stable supply. Investors who can legally access international markets may find opportunities to purchase at lower premiums. However, it's crucial to account for shipping, customs, and regulatory restrictions to avoid complications. Finally, maintain a long-term perspective. Market squeezes can create short-term excitement and price spikes, but history shows that precious metals retain value over the long term. Physical silver and gold are not just investments. They are insurance against financial uncertainty, currency devaluation, and geopolitical turmoil. Patience and strategic stacking are key. Let's start with silver. Over the past few months, we've seen wild swings, prices spiking to highs above $82 per ounce and then collapsing to lows around $76 in the same session. This kind of volatility is not unusual for silver, but it highlights the importance of support and resistance levels. Currently, the 50-day moving average is acting as a dynamic support line, preventing silver from collapsing further. Investors and stackers should monitor this closely, as a breach could signal a deeper corrective phase, whereas a bounce here may indicate the continuation of the bull run. The gold-to-silver ratio is another key indicator. Recently, this ratio widened to around 58.1, showing that silver is relatively undervalued compared to gold. Historically, when the ratio exceeds 60.1, silver tends to outperform gold in the following months. This is a crucial signal for investors looking to maximize gains by strategically adding silver to their stack while still holding gold for stability. Now let's look at gold. Gold has seen consistent demand from central banks, particularly China, which continues to stockpile gold steadily. This sustained official demand, combined with geopolitical uncertainty and inflationary pressures, is one of the main reasons why gold is less volatile than silver right now. The key technical levels to watch are $4,500 as a psychological and technical resistance and $4,400 as support. A break above resistance could trigger another historic run, while support levels provide a solid base for accumulation. Historically, times of crisis, whether political, financial, or supply chain disruptions, have caused surges in both silver and gold demand. The Korean market freeze we discussed earlier is a modern example, echoing patterns seen during the 2020-2022 silver squeeze. During those years, contract deliveries spiked, showing that physical metal demand can quickly overwhelm available supply. For long-term stackers, this reinforces the importance of accumulating physical metal steadily, rather than chasing short-term price movements. Technical indicators like the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, can also guide decisions. Currently, silver's RSI hovers around 46, reflecting a mild corrective phase after recent gains. MACD indicators suggest weakening momentum, but not an outright reversal. This means that while short-term volatility is expected, the long-term upward trend remains intact. Finally, pay attention to volume and delivery reports. Recent reports show massive silver contract deliveries, signaling that physical demand is real and persistent. When high-profile investors or institutions purchase large quantities of silver, it creates strain on supply, which is bullish for the market over time. Consider using a dollar-cost averaging approach, adding small amounts consistently rather than trying to time the market perfectly. This approach mitigates risk while allowing you to steadily grow your stack. For those focusing on physical silver, pay attention to bars versus coins. While bars may offer lower premiums, coins provide flexibility and liquidity. Both have a place in a diversified strategy. For gold, the focus is slightly different. Gold acts as a hedge against inflation and geopolitical risk. With central banks like China continuing to buy and global uncertainties rising, holding gold can stabilize your portfolio during turbulent times. Combining gold and silver allows you to balance stability with growth potential. Gold anchors your portfolio, while silver amplifies returns when momentum surges. It's also crucial to monitor market news and supply signals. Events like the Korean market freeze, high-volume deliveries in the US, and central bank purchases can move prices quickly. Staying informed allows you to react strategically rather than emotionally. Remember, volatility is normal in precious metals markets, and short-term price swings should not derail long-term stacking goals. Now, a few practical tips for protecting your wealth. Secure storage. Ensure your physical metals are safely stored, either in a reputable home safe or a trusted depository. Liquidity planning. Keep a portion of your stack easily accessible in case of urgent market opportunities or personal needs. Diversification. Don't rely solely on precious metals. Consider them part of a broader wealth strategy, including cash, stocks, or other assets. Education. Continuously learn about global markets, geopolitical events, and historical trends to make informed decisions. Finally, I want to emphasize the financial disclaimer. Nothing in this video or channel constitutes financial advice. All investments carry risk, and past performance does not guarantee future results. Always do your own research. Consider consulting with a licensed financial professional, and invest only what you can afford to lose. The strategies and insights shared here are for educational purposes only. Thank you so much for watching this full series on Silver&Metal IQ. I hope you found it insightful, educational, and actionable. If you enjoyed the content, please like, share, comment, and subscribe to support the channel. We're striving to reach 100,000 subscribers this year. Stay informed, stay strategic, and remember, silver and gold are more than metals. They're sound money, historical stores of value, and tools for financial resilience.